Very much for being here. The Domestic Policy Subcommittee of the Oversight and Government Reform Committee will now come to order. Today's hearing is the first of several Domestic Policy Subcommittee hearings on the topic of the $54 billion loan guarantee program for a new wave of nuclear power plants. Today, the subcommittee will hear from non-governmental proponents and critics of the federal loan guarantee program. Without objection, the chair and ranking member will have 5 minutes to make opening statements, followed by opening statements not to exceed 3 minutes by any other member who seeks recognition. And without objection, members and witnesses may have 5 legislative days to submit a written statement or extraneous materials for the record. American taxpayers have very recent experience with the cost of bailing out businesses. Today's hearing evaluates the likelihood that taxpayers will be saddled with a new bailout. This time the bailout would be for the nuclear power industry. During the 1970s and 1980s, economics halted the spread of the nuclear power industry. Cost overruns in building nuclear power plants averaged more than 200%. Utilities abandoned 100 plants during construction, around half the plants they had planned. Taxpayers and ratepayers reimbursed utilities for most of the more than $40 billion cost of these abandoned plants. Ratepayers bore well over $200 billion in cost overruns for completed nuclear plants. In 1985, Forbes magazine called this, quote, the largest managerial disaster in business history, a disaster on a monumental scale, unquote. Now the nuclear industry wants to have a renaissance. They assert that new technologies and standardized plant designs will produce results that are totally different from their prior history of mismanagement, cost overruns, and taxpayer or ratepayer bailouts. They say that the cost of plant construction will be lower, that there will be no cost escalations or construction delays, and that the problem of disposal of nuclear waste will be resolved. But Wall Street isn't buying it. The nuclear industry can't get private capital to fund its rebirth. So to have any comeback, they need tens of billions of dollars in federal loans and federal loan guarantees backed by American taxpayers. The government appears to be ready to provide it. On June 30, 2008, the Department of Energy asked for application for $18.5 billion in loan guarantees for nuclear plant construction. The current administration is seeking to triple that amount to $54.5 billion. The Department of Energy announced its first nuclear loan guarantee on February 16, 2010, an $8.3 billion loan guarantee to the Southern Company for construction of 2 reactors in Georgia. Not to worry, the nuclear industry and the U.S. Department of Energy say the risks to taxpayer are low. However, the Congressional Budget Office estimated in 2003 that a nuclear power plant project would have a, quote, well above 50% unquote, chance of defaulting on its loan guarantee. And that was for a plant that was estimated then to cost only $2.5 billion, with only 50% of that cost covered by a loan guarantee. Cost estimates increased substantially after the CBO report in 2003, and Standard & Poor's predicted in October 15, 2008, that the construction costs of nuclear power plants would soar even further. Moody's has referred to the construction of a new nuclear power plant as a bet-the-farm investment for most companies. The purpose of this hearing is to determine whether taxpayer-financed loan guarantees for nuclear power plants are necessary to jumpstart the nuclear renaissance, whether they are being priced correctly, and whether they're likely to create a multi-billion-dollar liability for the American taxpayer and a multi-billion-dollar bailout for the nuclear industry. As my Republican colleagues have pointed out in their February 3, 2010 policy brief, quote, while loan guarantees can help utilities with near-term financing, they also create taxpayer liabilities, dole out preferential treatment, and distort capital markets, unquote. We're here today from witnesses from all parts of the political spectrum, Democrats and Republicans, conservatives, moderates, liberals. Finally, a source for a March 5, 2010 article in the Los Angeles Times described the situation the subcommittee is examining in the following way. Say you're buying a car. The salesman has a long history of telling lies, covering up mistakes, and breaking promises. He's trying to sell you a car that doesn't exist yet. So he's not sure what it will look like. It's likely to cost at least 2, maybe 3 times what it says on a sticker. almost certainly will take him much longer to deliver it than he says it will. So the question before us, why would anybody buy that car? Chair recognizes Mr. Jordan.
Thank you, Mr. Chairman. And thank you for holding this hearing. When I travel around our district and our state talking about the future of our country, the issue of energy always comes up. And I like to frame it like this. Americans instinctively know that the world is a better place when America leads. We can lead economically, militarily, only if we have access to reliable and affordable sources of energy. That is why I'm an advocate for a common-sense, all-the-above American energy solution. Everyone here agrees that Americans need cost-effective energy, especially in these tough economic times. Unfortunately, some of my friends on the other side of the aisle take a position on energy policy that is unrealistic at best and disingenuous at worst. On the one hand, they tell us we have to reduce carbon emissions or the sky will fall because of man-made global warming. On the other hand, they impose such draconian regulatory burdens on building new nuclear power plants, the only zero-carbon source we have, that no nuclear power plant has been approved in over 30 years. At the same time, they continue to pour billions of dollars we don't have into windmills and solar panels that alone cannot deliver the energy we need. We cannot power our lives and our economy relying solely on sources of power like windmills and solar panels. Even this Congress can't pass a law that makes the wind blow or the sun shine. Does this mean that wind and solar shouldn't be part of the energy mix in the country? Not at all. We need an affordable energy that is available around the clock. We need an all-the-above energy policy where consumers, businesses, and the free market, not bureaucrats and politicians in Washington, make energy choices. I am skeptical of all government subsidies because I don't think Washington has the wisdom or, frankly, the ability to pick the right solutions for our nation's energy needs. That's what the free market does so well. I do not want the arrogance and abuse of power we saw with the government takeover of health care turn into the blueprint for restructuring the energy sector of our economy. The real reason we are here today is because some people are ideologically opposed to nuclear power, and the only reason these loan guarantees exist is to offset the cost of burdensome regulation that has been imposed by those who seek to impose their agenda on America's energy future. The best thing we can do as legislators is to clear away the thicket of regulations and subsidies that frustrates the market's ability to find the right mix of affordable energy solution that our country needs. The solution, quite simply, is less hubris, less government, more humility from Washington politicians. Thank you, Mr. Chairman. I yield back our time.
I thank the gentleman. For those who just joined us, the topic of the hearing is the $54 billion loan guarantee program for a new wave of nuclear power plants. Chair recognizes Mr. Foster. Mr. Issa, do you want to check in the cloakroom to see if Mr. Issa? Okay, fine. Okay, if there's no more opening statements, I'm pleased to announce that the subcommittee will now receive testimony from the witnesses who are before us. I want to start by introducing our first panel. Mr. Peter Bradford is a former member of the U.S. Nuclear Regulatory Commission, former chairman of both the New York State Public Service Commission and the Maine Public Utilities Commission. He currently chairs Vermont's Public Oversight Panel on the reliability of Vermont Yankee Nuclear Power Plant. He was a member of the 2007 Keystone Center Collaborative on Nuclear Power and Climate Change and the 2006 National Academy of Sciences panel evaluating alternatives to continued operation of New York's Indian Point nuclear plants, and he's also advised several international bodies on nuclear issues. He's a graduate of Yale University and Yale Law School. Welcome, Mr. Bradford. Next is Dr. Arjun Makhijani. He is the president of the Institute for Energy and Environmental Research. He earned his Ph.D. in nuclear fusion at the University of California in Berkeley. He's author of numerous books and studies, including Carbon-Free and Nuclear-Free, A Roadmap for U.S. Energy Policy. That was in 2007. He is a fellow of the American Physical Society and has served as a consultant to the Tennessee Valley Authority, Lawrence Berkeley Laboratory, and several agencies of the United Nations. Welcome, Dr. Makhijani. Mr. Jack Spencer is a research fellow in nuclear energy at the Heritage Foundation's Rowe Institute for Economic Policy Studies, where he concentrates on subsidy policy, technology issues, and nuclear waste management. Previously, Mr. Spencer worked at the Babcock and Wilcox companies on commercial, civilian, and nuclear energy issues, and that would be military nuclear energy issues. Thank you for being here. Finally, for this panel, Ms. Leslie Cass. Ms. Cass is Senior Director of Business Policy and Programs of the Nuclear Energy Institute, where she's responsible for developing and managing programs related to the business and financial aspects of the nuclear industry. Ms. Cass has 17 years in the industry, having worked for utilities and a uranium enrichment company. She holds a bachelor's degree in materials science and engineering from MIT and an MBA from Duke University's Fuqua School of Business. I want to thank all the witnesses for appearing before the subcommittee. It's the policy of the Committee on Oversight and Government Reform to swear on all witnesses before they testify. I would ask that you please rise and raise your right hand. Do you solemnly swear to tell the truth, the whole truth, nothing but the truth? Thank you very much. Let the record reflect that each of the witnesses answered in the affirmative. I would ask each witness to give a brief summary of your testimony, and to please keep this summary under 5 minutes in duration. Your entire written statement will be included in the record. And I'm grateful for your presence here. Mr. Bradford, you'll be our first witness on the panel. You may proceed. Do you want to bring that mic a little bit closer? Go a little bit more. People can't hear you in the back.
Take the risks that investors and lenders are refusing to assume will reduce climate change. The opposite is true. Such an undertaking will undermine the fight against climate change by diverting money and attention from the resources that offer much larger atmospheric pollution reductions much sooner and less expensively. One must begin by understanding the reason that new nuclear plants have not been built in the U.S. for decades. It has nothing to do with the U.S. reactor licensing or regulatory processes, which licensed more plants than the next several countries combined. It has everything to do with cost and with risk. Competitive power procurement, as adopted in free market economies over the last 25 years, shifts the economic risk of all new power plant construction, risks such as plant cancellations, cost overruns, and emergence of cheaper competitors, from the customers to investors and lenders. Aware that each of these risks had hit the nuclear industry hard in the recent past, investors and lenders would not put their own money at risk by committing to competitive prices and delivery schedules for new reactors. Loan guarantees are the centerpiece of the present effort to reverse the successful 30-year evolution of competitive power markets by shifting the risks to taxpayers. But loan guarantees do not lower any actual cost in the way that cheaper steel or concrete would do. For example, the savings that the recently announced $8.3 billion loan guarantee appear to produce for Georgia's proposed Vogtle reactors are offset by a new taxpayer risk exposure of almost $100 taken on by every family in America. And every additional $10 billion in taxpayer-backed loan guarantees will add another $100 to this exposure. At its peak in 2008, the nuclear renaissance consisted of 23 existing and projected applications for 34 new reactors. Since 2008, reality has set in. Nuclear cost estimates have risen, demand has fallen, as have the cost estimates for most major alternatives. Several nuclear projects have been canceled outright. Most of the remaining 16 applications for 24 reactors have experienced combinations of major cost overruns and major delays. Most, indeed probably all, of these reactors will not be built without loan guarantees. The economic and political impact of trying to charge the full cost to the customers is just too great. Customer backlash in Florida and in Texas has already demonstrated this. By way of response to the subcommittee questions directed to me, I'll summarize as follows. First, are the cost overruns in the construction of nuclear power plants a thing of the past or a present-day problem? Well, we have no current U.S. nuclear construction experience on which to base an answer. However, the trebling of U.S. nuclear cost estimates in less than a decade is not encouraging. Experience in Finland and in France with the design that Areva proposes for Maryland's Calvert Cliffs, a loan guarantee finalist, is also not encouraging. In Finland, the Areva reactor, originally scheduled to be online last summer, has doubled Areva's cost estimate and fallen at least 3 years behind a 4-year schedule. Some Asian nations claim more success in building to schedule and budgets. Energy Secretary Stephen Chu asserts that if the proposed loan guarantees result in plants that come online on time and on budget, private capital for new nuclear will then become available. But this is wrong. Today's on budget is so high in relation to the price of alternatives, to the prices projected in our power markets, and to the price of energy efficiency that even if new U.S. reactors come online on budget, the financial community will not invest. Second, do we currently have such a demand for electric power that we need to rush into construction of multiple nuclear plants? The U.S. has little or no demand for wholesale electric power, and new nuclear is forecasted 12 to 20 cent per kilowatt-hour price range. If we make wise use of far less expensive energy efficiency, renewables, and natural gas, we will not face electricity shortages even if we adopt policies that put a meaningful price on greenhouse gas reductions. Third, do increased loan guarantees for nuclear power plants misdirect resources? Yes. Those who argue that we have to subsidize many new reactors along with all of the alternatives ignore the economic reality of limited resources and the fact that new nuclear reactors cannot produce near-term greenhouse gas reductions. Furthermore, I can attest from my own experience regulating in Maine and New York that entities and states committed to building large nuclear projects will de-emphasize and even resist alternative sources. One need only look at New Hampshire's 1980s resistance to Hydro-Quebec power, or the opposition of Maine utilities to renewable cogeneration and energy efficiency, while the region's utilities struggled to finish Seabrook and Millstone 3 to see this effect clearly. The same was true in New York, while Shoreham and 9 Mile Point 2 preoccupied the state's utilities, and the same is true in Florida today. However, the problem of misdirected resources is much broader than this. Loan guarantees do not create new capital. They merely create a favored class of borrowers who will have easier access to the available capital than will all other would-be borrowers. Murray Wiedenbaum, who was later chairman of President Reagan's Council of Economic Advisors, critiquing the failed program to manufacture synthetic fuel from coal many years ago, noted, "A basic function that credit markets are supposed to perform is that of distinguishing credit risks and assigning appropriate risk premiums. This function is the essence of resource allocation by credit markets. As an increasing proportion of issues coming to credit markets bears the guarantee of the federal government, the ability of the market to differentiate credit risks inevitably diminishes." Fourth, will the proposed Clean Energy Deployment Administration adequately deal with the risk of defaults? The answer is not as presently written. The Senate version of CETA, because it has the potential to underwrite unlimited nuclear loan guarantees, is particularly problematic. Secretary Chu recently estimated that the price to be charged for a loan guarantee would range between 0.5% and 1.5% of the face value of the guarantee. For the conditional loan guarantee recently approved for the Vodal units, this would mean that the average family would receive between 50 cents and $1.50 for its $100 exposure. Other estimates of reasonable credit subsidy fee are considerably higher. For example, the Congressional Budget Office estimated 30% in 2003. Standard & Poor's estimated 4 to 6%. The Center for American Progress recently did an analysis concluding that the payment should be 10%. Underpricing of risk is, of course, a root cause of the current financial crisis. To make matters worse, the Department of Energy apparently intends to keep secret the credit subsidy fee charged to each guarantee recipient. The people disadvantaged by this secrecy will be first the public, who will not be able to quantify the extent to which DOE has exposed American families to uncompensated risk. Second, builders of other forms of power generation and energy efficiency, who will not be able to prove what now seems very likely, that DOE intends to charge less for guarantees to highly risky nuclear ventures than it will charge for loan guarantees to more secure renewable and solar ventures. Third, state utility regulators, who may be unable to set rates based on actual costs, since loan recipients may allege that they cannot disclose these costs in a public forum. In conclusion, whatever the appeal of offering a limited number of loan guarantees to a few first-mover plants, meaning 6 or 7, as part of a bargain that succeeds in passing a meaningful cap-and-trade program, the discussion of loan guarantees in Congress seems to have spun far outside of that orbit. A larger commitment would proclaim new reactors to be a climate change winner when all meaningful economic evidence is to the contrary. It would put energy and climate policy at the service of nuclear power. Sound public policy works the other way around. Thank you very much.
Thank you, Mr. Chairman. I really appreciate the opportunity to testify before you, and I just want to take this personal opportunity to thank you for reading my book, Carbon-Free, Nuclear-Free, and for making part of your presidential campaign. Thank you very much. You asked me 6 questions, and I'll just go question by question and summarize my testimony along those lines. The first question was, why won't Wall Street invest in nuclear power plants, and why does Moody's call them bet the farm investments? Now, I'll just give you some examples, starting with a quote from the CEO of General Electric, Mr. Immelt. He was quoted in the Financial Times as saying, if you were a utility CEO and looked at your world today, you would just do gas and wind. You would say they are easier to cite, digestible today. I don't have to bet my company on any of this stuff. You would never do nuclear. The economics are overwhelming. Now, he was promoting loan guarantees because you couldn't do nuclear without betting the company. What does betting the company mean? Let's take some examples. Progress Energy wants to build 2 reactors in Florida, whose estimated cost is $17 billion. Now, these are company estimates. Progress Energy's market capitalization, when I wrote this testimony last month, was $10.85 billion. That is, the cost of the project is a lot more than the market cap of the company. Florida Power, a little bit better. Its price tag is $14 billion for 2 reactors, and its market capitalization last month was $19.41 billion. But still quite close to the market capitalization of the company. If you look at CPS Energy, which is one of the country's largest publicly owned utilities, a municipal utility of the city of San Antonio, its entire assets, gas, electric, buildings, transmission, distribution, the net value of those assets at the end of its last fiscal year in January 2009 was $6.4 billion. And it had at one time 50% of a 2-reactor project in South Texas, and that 50%, 1 reactor, is now estimated to cost $9.1 billion, quite a bit more than the net worth of the whole company on the books, on its own books. Now, Wall Street has flatly refused to finance these projects. There are 3 problems. It's not just the high cost. It's the long lead time compared to alternatives, which also compounds the risk. And it is the large unit size, which also compounds the risk. And I just would like to add that Mr. Bradford mentioned that nuclear would squeeze out alternatives. And one reason it squeezes out alternatives is that when you put more than the value of your company on one project, and that project isn't going to return $1 to you for 8 or 10 years, you can't afford to put another comparable investment in anything else. Now, in Florida, ratepayers are paying in advance for these reactors without any assurance that they're going to get any electricity in return. The legislature there passed a construction work in progress law, and it's not just homeowning ratepayers that are protesting. Businesses are also protesting. Here's what the Washington Post said. Utilities' advance payments are consumers' losses, and businesses such as Georgia Industrial Group and Georgia Textile Manufacturing have joined consumer and environmental groups in combating state laws and higher rates. Now,
the 4 reactors in Florida are in some question as a result of this ratepayer protest, including ratepayers, business ratepayers, who are not against nuclear power. They just say, we don't want to pay in advance, and they have no guarantee they're going to get anything for this money. It's like giving a builder an advance to build you a house, but you have no contract that says they're actually going to build it and give you the keys. If they abandon the project halfway, you have no recourse. Now, the San Antonio case is actually very interesting because the city's utility spent about $370 million on paperwork and initial engineering. They don't have a final price. They won't have a final price till 2012. And its partners, NRG Energy and Toshiba, were 50-50 initially in this project. There was an alleged cover-up of the cost overruns. Initially, the company had said $5.4 billion, then $6 billion, and $7 billion. When I arrived on the scene in San Antonio in March 2008, when I assessed the project, I felt the cost would be between 12 and 17 billion in round numbers, or as you have said, Mr. Chairman, 2 to 3 times what the company said at the time. By last fall, it seemed clear that their cost estimate was going to be something like 18 billion, a little bit more than my high end. Now the project is in something of a mess because CPS Energy wants to withdraw. You asked me about new reactor designs.
Just ask the gentleman if you could wrap up your testimony, and then maybe we can get to some of the other points in the question period.
Sure.
Thank you.
Should I wrap it up now? Or do you want me to go over some of the other points?
If you would make the last point you wanted to make, and then we'll have to move on.
Okay. The last couple of points are that there is no reactor that we have that is proposed to be built that is fully certified as of now, because the certified reactors have design modifications they've asked for. And I would say that 3 or 4 years ago, I believed that it would be impossible, essentially. It was an educated guess to make a renewable energy system in this country. And I changed my mind when I did the research. That's why I wrote my book, Carbon Free, Nuclear Free. I believe it's possible to do an economical energy system, and I've debated nuclear energy and nuclear power proponents on this numerous times since my book was published.
Thank you, Dr. Makajani. And members of our committee will have an opportunity to get your questions and some of the other points you wanted to make. I'm sure you'll be able to get in. Chair recognizes Mr. Spencer. Thank you for being here. You may proceed.
Chairman Kucinich, Ranking Member Jordan.
And would you pull that mic a little bit closer so we can all hear you? Thanks.
My name is Jack Spencer, and I'm Research Fellow for Nuclear Energy Policy at the Heritage Foundation. The views I express in this testimony are my own and should not be construed as representing any official position of the Heritage Foundation. A limited loan guarantee program can help overcome some near-term financing obstacles, but President Obama's expansion could transform a limited program into a broader one that threatens to institutionalize both the existing systemic challenges as well as inefficiencies that subsidies ultimately create. By subsidizing a portion of the actual cost of a project, nuclear or otherwise, through a loan guarantee, the government is actually distorting the allocation of resources by directing capital away from more competitive projects. These subsidies have 4 market-distorting properties that I would like to discuss. First, the loan guarantee artificially discounts the cost to build a project, which allows the recipient's project to be market viable at a point where it otherwise would not be. This allows the recipient to focus on other measures, even securing the next subsidy, rather than addressing cost-inflating issues. Second, this artificial price reduction removes the incentive to look for less expensive or more competitive options. It also hurts competition within the nuclear industry. A utility that cannot afford a large, subsidized reactor might be able to afford multiple smaller ones. This would create competition, and the subsidized technologies would either have to reduce costs or lose market share. Third, a major problem facing nuclear power in the United States is not that it lacks subsidies, but that the regulatory environment does not promote growth, innovation, or competition. Regulatory reforms could substantially reduce the investor risk, which would be reflected in lower financing costs. Guaranteeing the loans reduces near-term pressure to fix this ongoing problem. And finally, they suppress private sector financing solutions. Companies routinely invest in projects with substantial risk without government loan guarantees. Finding a way to develop an investment is at the heart of free enterprise, but loan guarantees distort this process and remove the incentive to come up with better long-term solutions. If loan guarantees are expanded, they must be coupled with reforms and conditions. Any expansion of the loan guarantee program should be accompanied by the following 5 conditions, which would help reduce their market-distorting effects, protect the taxpayer, and ensure a strong, market-viable nuclear industry in the long term. First, end loan guarantees and capital subsidy programs. Stopping the program at $54.5 billion in total loan guarantees, which is the President's total, would at least limit the damage and provide a deadline whereby industry and government must have resolved their outlying issues. Second, ensure that the recipients pay the full cost of the subsidy. While the President's budget did not request funds to pay for the subsidy cost, legislation introduced over the past year has. This should be avoided. An accurate financial assessment should provide a market incentive to reform the policies that give rise to the risk to begin with. This will occur, however, only if the true cost of the subsidy is assessed and if guarantee recipients are responsible for paying that cost. Third, make recipients privately refinance within 5 years of project completion. Rather than a long-term financing option, the loan guarantee program should be viewed as a bridge program to protect investors against project failure during its most vulnerable stages. Upon completion, loan recipients should privatize liability by refinancing without support of additional taxpayer backing. Fourth, limit loan guarantees to no more than 2 plants of any reactor design. Completing the permitting process for 2 plants that share a single reactor design should be sufficient to establish regulatory integrity. This condition would also ensure that no one reactor design monopolizes the program and that federal regulators diversify their regulatory experience. And finally, limit to 2/3 of the loan guarantee program that can support a single technology. Because regulatory support is a necessary prerequisite to reactor use, and the regulatory environment favors large light water reactors, nuclear investors tend towards this technology as it poses the least regulatory risk. Ensuring that the subsidy is not consumed by a single reactor type should help break the regulatory monopoly currently held by light water reactors by lowering the relative risk of emerging commercial nuclear technologies. If not subsidies, then what? Whether through the promise of subsidies, regulatory problems, unworkable waste management policies, or DOE programs that stifle competition, the current policies are not working. The following reforms should be pursued instead of subsidies. Reform the permitting process for new nuclear power plants. Creating a more efficient and predictable permitting schedule should be a top priority, but that alone is not enough. The NRC must also be better prepared to regulate reactor technologies beyond large light water reactors. Waste management policy reform. The current system is driven by government programs and politics. There's little connection between used fuel management programs, economics, and the needs of industry. Any successful plan must grow out of the private sector and be driven by sound economics. And finally, supporting the NRC's authority to determine the safety of Yucca Mountain. The NRC should be allowed to review the Department of Energy's permit application for the Yucca Mountain constructed and operated safely. In conclusion, a true nuclear renaissance cannot be micromanaged from Washington, but with the right free market policies in place, nuclear energy has a chance to literally change the world. That concludes my testimony. I look forward to your questions.
Thank you, Mr. Spencer. Ms. Cass, you may proceed.
Thank you, Mr. Chairman. Chairman Kucinich, Ranking Member Jordan, and members of the subcommittee, thank you for your interest in loan guarantees for the construction of new nuclear power plants to meet our nation's energy needs and reduce carbon emissions. I appreciate the opportunity to speak with you today. As the President stated last month at the announcement of the conditional commitment for loan guarantees offered to the Vogtle nuclear project, to meet our growing energy needs and prevent the worst consequences of climate change, we'll need to increase our supply of nuclear power. It's that simple. Investing in nuclear energy remains a necessary step. I hope that this announcement underscores both our seriousness in meeting the energy challenge and our willingness to look at this challenge not as a partisan issue, but as a matter far more important than politics, because the choices we make will affect not just the next generation, but generations to come. To make the necessary transformation to a low-carbon economy while we upgrade aging energy infrastructure, consensus estimates show that the electric sector must invest between $1.5 and $2 trillion by 2030. This will fund new power plants, transmission and distribution systems, energy efficiency measures, and environmental controls. To meet the national policy objective of reducing carbon emissions, the public and private sectors must work together to ensure clean energy is affordable for consumers and businesses alike. By reducing the cost of capital, the DOE Loan Guarantee Program, authorized by the 2005 Energy Policy Act, serves the public interest by accelerating deployment of clean generating technologies at a lower cost to consumers. The federal government already manages a successful loan guarantee portfolio of approximately $1.2 trillion, which on balance returns more to the Treasury than it costs the taxpayer. The federal government uses these credit support programs to support shipbuilding, steelmaking, rural electrification, affordable housing, and many other purposes. To ensure the protection of the taxpayer interest, all projects seeking DOE loan guarantees will be subject to detailed due diligence and underwriting by a rating agency and by the DOE. This due diligence evaluates the technical, legal, and financial attributes of each project. The companies building new nuclear power plants will have significant shareholder equity, $1 billion or more per project, at risk. This equity is in a first loss position, meaning that the company would forfeit that equity in the event of a default. As a result, the companies seeking loan guarantees for new nuclear power plants have a powerful incentive to ensure that the projects achieve commercial success. The amount of misinformation about nuclear plant construction and loan guarantees is remarkable. One of the more egregious examples is the continued use of a 50% default rate from a 2003 CBO analysis of a different loan guarantee program that was never enacted. CBO Director Douglas Elmendorf was moved to explain on March 4th that the 2003 report, quote, reflected information about the technical, economic, and regulatory environment as it existed in 2003, almost 7 years ago. Such generalized estimates of credit risk may not apply to a guarantee for any particular power plant because of variations in the technical, economic, regulatory, and contractual characteristics of each project. Without such information, much of which would be proprietary, CBO has no basis for estimating the cost to the government of any specific loan guarantee of this type, end quote. Detailed analysis and historical data demonstrate that the new nuclear power projects being proposed for DOE loan guarantees provide a very high degree of lender protection. A realistic analysis of default probability and recovery rate based on project specifics will produce credit subsidy costs sufficient to protect the taxpayer's interest. Credit subsidy calculations must be approved by DOE's Credit Review Board, the Office of Management and Budget, and by the Treasury Department. Given the very low probability of losses associated with nuclear projects, the benefits far outweigh the risks. Electricity consumers will benefit from low-cost clean energy. Southern Company projects that its $3.4 billion portion of the loan guarantees for the 2 reactors at the Vogtle station would save consumers $15 to $20 million in interest costs annually. The program will create jobs for American workers. Each plant will generate 1,400 to 1,800 jobs during construction, with 2,400 at peak. 400 to 700 permanent jobs for plant operations, and 400 to 700 additional jobs in the community to support the plant workforce. Construction of new nuclear plants will create demand for commodities like concrete and steel and hundreds of components, large and small, that benefit American manufacturers. In addition to the existing U.S. manufacturing supply base, the industry is reaching out through manufacturing workshops to help businesses identify the opportunities in new plant construction. For example, over 300 companies from Ohio participated in workshops just last year. In conclusion, the Nuclear Loan Guarantee Program is an opportunity to build the clean energy facilities necessary to support our economy and to put Americans back to work. The analytics show that the risks of default are small, and as the President explained, the benefits cannot be ignored. Mr. Chairman, thank you again for the opportunity, and I look forward to your questions.
Thank you very much for being here, and I'd like to start with a question to you, Ms. Cass. Department of Energy representatives have been quoted as saying that the credit subsidy fee that Southern Company will pay for its $8.3 billion federal loan guarantee is proprietary to Southern Company and, quote, will remain confidential, unquote. Is that the industry's position, that the amount of credit subsidy fees for nuclear plant loan guarantees should be kept secret and should not be disclosed to the public or to the company's shareholders and bondholders?
I believe that the process by which we derive the credit subsidy cost should be very transparent for all stakeholders and for all projects, both those that are renewable, for which the government is covering the credit subsidy cost, and those for nuclear and other technologies where the borrower pays. Now, the very project specifics, I do believe, get into confidential information for contracts, so some of those pieces of information would need to remain proprietary, and where you draw the line, obviously, that's up to DOE and OMB.
Mr. Bradford, would you like to comment on that question? And could you pull the mic closer? The question relates to, should the credit subsidy fees remain confidential? Is it proprietary? Do the people,
Yes,
taxpayers, have no right to know what's kind of skin they have in this game, or, what do you think?
I think the proposition is beyond sober analysis.
What do you mean? I mean,
There is no conceivable justification for withholding the credit subsidy fee being charged to these projects.
Well, but wait, you're not answering the question. I mean, they're saying it's proprietary. You know something about the nuclear industry, so is there any justification in terms of the business sense that it's proprietary information?
Not the credit subsidy fee itself. It can't possibly be proprietary. It's the amount that the taxpayers are receiving in return for extending the loan guarantee. And they're being told, the taxpayers, that they can't know what level of protection they're receiving. The justification that DOE advanced, that is that other applicants for loan guarantees might complain if they felt that they had gotten unfairly treated, is in fact the exact reason why they should be aware of what type of treatment has been extended to their competitors. If the solar industry is being charged 10% and the nuclear industry is being charged 1%, damn right they should know it and be able to complain about it.
Dr. Marcagiani, what's your opinion of a credit subsidy fee that's secret and not disclosed to the taxpayers?
Well, Mr. Chairman, first of all, the subsidy fee will give us some idea of how the government values the risk of default and whether it's realistic or not. In my opinion, the risk of default is quite high because nuclear power plants take so long to build. They may be economically obsolete before this first set goes online.
So why would this subsidy fee need to be made public then?
Well, we need to know whether the subsidy fee is adequately covering the risk and what the risk analysis is that leads to a specific sum of money.
Mr. Spencer, what's your position on this credit subsidy fee? Do you think from a business standpoint it ought to be proprietary and should remain confidential?
Well, I'm not in the business sector, so it's not really fair for me to answer from
well,
that
from an
perspective.
economic standpoint.
But from a public policy standpoint, I think that we do need transparency over the subsidy cost, and I think that it's critical because really that has a lot to do with as we just heard, what the risk is associated with this. And I think it works on both sides. I tend to believe that the risk associated with nuclear power would be relatively low. So I think that it should be made public, but it is absolutely critical that that those important business aspects remain confidential. So we need to figure out a way to do that.
Okay, thank you. Ms. Cass, on the back cover of the current National Journal, the staff could put the copy up, there's an ad with the headline, Southern Company is investing $6 billion in clean, reliable, affordable energy. My question to you is this: wouldn't it be more accurate if Southern Company had stated that it was investing $6 billion of taxpayers' money, that this $6 billion is going to be coming from taxpayers' money from the federal financing bank? Isn't that right?
Actually, sir, I had in my testimony, Southern Company's portion of the loan guarantee is $3.4 billion, so they are getting a guarantee for a $3.4 billion loan, and the rest of their portion of the project, they're about a 46% owner, would come from owner's equity, so there's quite a bit of their own cash invested as well.
Is that loan taxpayers' money that they're referring to?
The $3.4 billion?
Is there any taxpayers' money in there at all?
It comes from the federal financing bank because that is the way the loan guarantee program rule is written. They're required to access that from the federal financing bank.
And that's taxpayers' money, right?
It's the federal financing bank, so yes.
Chair recognizes Mr. Jordan.
Thank you. Mr. Chairman, let me, housekeeping first, if I could ask unanimous consent to get Ranking Member Ice's statement entered into the record.
So ordered.
Thank you. Let me go to Mr. Spencer and Ms. Cass, if I could. Mr. Bradford, in his testimony, stated, and I'm reading from it, the reason that no new nuclear plants have been built in the U.S. for decades